As you all know, he's one of the most distinguished people we've ever had in finance, and has written a number of very important papers, not just the Black-Scholes paper, which was probably the most widely cited paper in the history of economics, but many other good papers on taxes, on reactions of stock prices to block trades, on capital asset pricing model, and a wide variety of other things. It's pretty obvious, I think, that most Nobel Prize winners are highly intelligent and creative, and Myron is. It's not so obvious that Nobel Prize winners are really nice human beings, and Myron definitely is. I can tell you he hasn't changed a bit in the 42 years that I've known him in that regard. There are even fewer Nobel Prize winners that are really witty and funny, and Myron is that too. So he's a very unusual Nobel Prize winner and a really wonderful person. So I'll hand the podium over to him, Myron. By the way, if you want to see the interview that I conducted with Myron, it's now in the archives of the history of finance. It's on the American Finance Association website. You can learn all about his entire life from the time he was born by looking at that interview. Myron.
Thank you, Dick, for the kind introduction. Actually, in the interview, he didn't bring up that when I first went to the University of Chicago, there was a fellow by the name of Andy Rosenfield, who was the Gorham Lexicon after he was a student at the school, and Andy asked me what day, who was I? And I said, I was a nudist. And he said, "You're a nudist? Why are you a nudist?" And he said, "Well," he said, "you don't look like a nudist. You're wearing clothes here at the school and teaching your classes." And I explained to him that for tax purposes, I had to wear clothes to teach, and therefore, a necessity of my job, I was able to deduct my uniform as an expense. So, very important to remember that. Let's see here. I got to figure out how to get this to work. Okay. There's only so many buttons I can push. That should come up now. I should go one more. It should come up in both places. Yeah. Oh, great. And I really enjoyed this morning's talk and the talks. And what I wanted to talk about this afternoon, and by the way, you can go forward and drink your coffee and that sort of thing, is one of the important things. You get old like myself, that you're relegated to the after dinner speaker or after lunch speaker. No longer they give you the prime slots. And basically the trick is that people's carbohydrate loads go up so their heads hit the table. So I have to jump around and have lots of topics, and as a hedge in case I see the heads hitting the table here in boredom. So I won't get to all these topics. You know, I was going to talk about Omega and hedge funds, and then since I won't talk about risk control, and I think it's very important if you're providing Omega services, which I'll define in a moment, you have to talk about risk control and financial innovation, which affects Omega. But if my talk goes over this year and there's another session next year, then I can give the last two pieces of it. But you know, that's and as an option person, you know, I'm always a hedger, so I always have more to talk about than less in terms of trying to decide what to do. So basically, what I'd like to do is talk about, and we talked about a lot of this this morning, but that I think that there's four paths that an ability to earn money in investing, and one is we talked about the systematic exposures, or the idea of taking what's called beta risk and an ability to earn returns just by holding these factor exposures, whatever they are. And there's a debate in the finance world what is priced factors and what aren't priced factors in the market. And so the But you can also have macro hedge funds and others who are predicting what factors are going to outperform other factors. And so those are called beta, or sort of beta or factor risks. And from the old days of the capital asset pricing model, and that beta was defined. And then we also have prediction of cash flows or risk parameters. And that's the second way, and that's what we tend to call alpha, or trying to find out the source of alpha in the marketplace. So predicting of cash flows and risk transfer. By the way, the pluses mean there's more behind it, but sometimes I'll open it up and sometimes I won't. So I know your curiosity will want to know what's behind the plus, but you're not going to see all of them, so don't worry about it. But, okay, so prediction of cash flows, which are defined to be alpha, and that's also prediction of cash flows or discount rate. The third way in which we make money is liquidity provision, and which I want to talk a little more about, and risk transfer. And I call those omega, okay, as opposed to alpha or beta, simply because we think that there's really not prediction per se. In a sense, you're reacting to opportunities to intermediate in the capital markets. So it's more of an intermediation function. And I could liken over time that trying to forecast factors or alpha could be it's a zero-sum game in the sense that you have to be more powerful or more innovative in your creativity to be able to garner extra returns through forecasting of factors or through forecasting of cash flows. But it actually, in liquidity provision, it may not be a zero-sum game in the sense for alternative investors who are involved in providing liquidity provision and risk transfer, simply because the other entities in the economy are willing to pay for the liquidity provision services and risk transfer services. So there's a difference between that there's a willingness to pay, other entities are willing to pay, and they knowingly pay. So that means that the entities are giving up returns for these types of services that are being provided. And for that reason, I call it omega. And obviously, I know a lot of you will say, well, why isn't there entry into the marketplace so that omega is eliminated, so that if ones are providing liquidity or risk transfer, which I'll define more in a moment, and I think it relates to the same reason why at times there is capital that's provided to the market, so there's a lot of liquidity in the system, and at times there's not a lot of liquidity, or there's alternatively times in which you have a lot of risk transfer and times you don't have a lot of risk transfer provision in the marketplace. But if it needs, it's a skill-based business to provide liquidity and risk transfer, then that business will be compensated and make a return to provision of those services in the economy, and others will be willing to pay for it. So we know, at least I've been told, that private equity firms, real estate is actually a business which provides liquidity to the market, because although I could sell my home on the instantaneously, someone referred to eBay today by Kaplan referred to eBay today by going to the eBay and putting my house on the market at 2 a.m. in the morning with no reservation price with a picture. I'm sure that I could sell it by 3 in the morning, but the price of the immediacy would be very large because the discount would be very large. So that if I have an ability to provide liquidity in the marketplace and for immediacy, that others who have a horizon that are longer than my horizon, which is the immediacy, would be probably immediacy would actually be making a return in excess of what I can make by actually investing in IBM or other very liquid assets that I can liquidate each day. So the liquidity itself is an inability in our society to hedge all the states of nature that could arise because of incomplete markets. And liquidity is priced as well because of the simple fact that I might act myopically and think that I have enough liquidity, or there's enough liquidity in the system, but there's an aggregation problem. My actions, okay, might be perfectly fine, but at the same time that there's others in the economy that are similarly thinking, and that if there are nonlinearities, then the aggregation problem leads to times at which the price of liquidity is far different. So, for example, we'd have a situation where everyone in Los Angeles thinks that they could sell their house or their real estate over a period of 3 weeks because there's a lot of demand for housing. Then they don't need to provide liquidity. But at other times, when myriad other people simultaneously are trying to liquidate their houses and not selling at the market price, then everyone is forced to provide liquidity to the market by not using eBay at 2 a.m. in the morning to liquidate their house. And so the actions of others are related through sort of in the market, and the price of liquidity is not constant in the system. And I will try to explain sort of a simple model that I have and why the price of risk transfer and liquidity change. So the price of omega changes. Sometimes the price of omega services is high. Sometimes the price of omega services is low. And as a result of that, it becomes fascinating to understand how asset prices are not only affected by systematic exposures, but by omega, where individuals are willing to pay more or less for the services of what I call compressing time, because it's a time series business, which I'll get to a little more in a moment. So risk transfer differs from liquidity provision in the sense that it goes back to our thinking of hedgers paying speculators, wherein we have the classic example of the miller, and the miller stores a commodity and hedges risk by transferring it. So we know the wheat crop comes in at one particular time, so there's excess inventory in the market that has to be carried forward in time until such time as the flour is then used to make the breads and cakes that we consume as consumers. So given the commodity, the wheat comes in the United States twice a year, but let's say that comes in at a particular time, the farmer transfers the risk of the storage of the wheat to the miller. And the miller, in turn, then carries this risk forward in time until the demand for flour reduces the amount of risk that the miller has. So the miller actually can take all the risks associated with holding or milling the flour, but the miller's expertise is in the activity of understanding the local community and the local community's need for flour and the risks associated with concentrating in their business, concentrating in the business of providing storage and then the flour for the local dealers, local bakers in the area. The risks, however, are larger, as we know, than the risk of the local business. The risks that the miller has include the generalized risks of the prices of inventory changing dramatically, or the changes of interest rates changing, commodity prices or currencies, for example, changes. And the miller can transfer that risk to the marketplace. And the miller can transfer the generalized risk through using futures contracts. So the miller transfers generalized risk to the futures market. the transfer of risk cannot be transferred, the idiosyncratic risk cannot be transferred. Starbucks, when it decides on selling coffee, must concentrate on providing the services of coffee to us, the consumers, but at the same time cannot transfer that risk, because if they transfer that risk, they can't make money. You have to concentrate if you're a real estate person or you're a seller of coffee or anyone. You have to concentrate in order to make money. On the other hand, there's the generalized risks that one has that probably have, for that person, zero present value, because they don't have expertise in those risks. Unless they do, they can retain those risks. But on the other hand, without generalized expertise, they would transfer those risks. And as a result of transferring those risks, there's a trade-off. If you transfer risk, then that means that there's less equity capital that's needed. So there's an efficiency of capital question. Is it less expensive, less deadweight costs to hold equity, or is it less deadweight cost to transfer risk? And through using derivatives or futures markets derivatives or other types of contract. Well, if their costs of hedging fall relative to the deadweight cost of equity, then it's the case that there will be the need for speculators, because as Mr. Greenspan said, as we've used more derivatives in our society, it has made us have more shock absorbers, or an ability to absorb risk generally. But the question becomes then, if that's true, who's taking the risk? You know, you can have a situation where you marry buyers and sellers, okay, but you also, there could be deficits or surfeits, and as a result, there needs to be an intermediary to carry the risks forward in the marketplace. And so you need the need for the speculator. In my view, the omega, or the prices of risk transfer, do not remain constant, but they change over time. And it makes it sort of a very fascinating to understand why the prices of liquidity and risk transfer change. In my view, the risk transfer business and liquidity business is a time series business. That markets work, or the intermediation process works in markets, because entities want to change their portfolio holdings. And Dick referred to one of my earlier papers, actually it's my thesis, but the idea of the, always in economics or finance, we're talking about substitution or flows. The idea that there's entities who want to change their portfolios either because of regulatory reasons or because of they want to transfer risk, the commodity comes in at a specific time, etc. And so those are the flows that affect the demand and supply of securities into the marketplace. Real estate coming in, or flows of investors coming in that would want to buy, or entities wanting to sell. And so, but the other hand, as they enter the market, the question becomes to what extent they affect the prices. In other words, to what extent the flows affect prices in the market, and as they affect prices through their demand or supply, that we have the substitution effect. Namely, that prices of similar securities cannot deviate too dramatically, or there will be entry into the market, there will be new supply. So, and that is always a trade-off. To what extent the flows overwhelm the substitution effect, and to what extent the substitution effect brings things back into equilibrium. And the issue is that it is a reactive business in the sense that intermediaries who provide omega to the market react to the opportunity to step in and actually to compress time. Because if we believe that the farmer sells the inventory to the miller at this moment, but we, the consumers, buy the breads and cakes over time or over here, then the way time is compressed is if the crop or risks are transferred to the market, so the speculator acquires some of the inventory components here, that by doing so, they're creating an increase in the supply of risk transfer services, which compresses time because the market becomes more efficient. It brings time together. It's as if everyone bought and sold here as opposed to waiting to acquire the flour for the bread and cakes at such time as the bread is consumed. So it's the compression of time, or making time compress, which is the key to the intermediation function, which again creates the substitution overwhelming the flows. But it's interesting as well that to undertake this business, it's sort of akin a little bit to the Heisenberg uncertainty principle, because in finance, because the idea when flows occur in the market, the information set that we observe is gigantic. You know, if you're in the real estate business, you understand there's so many pieces of information or uncertainties that one has to decide on how to intermediate or when the substitution effect is going to come into place, that prices relative to other assets could fall or rise, but basically there'd be, as we know, prices rise, there's new building, or prices fall, or people tend to speculate or come into the market and carry that inventory forward. So the how much inventory to hold at one time is based on a model of what substitution should be and what the relative prices of other assets are that are substitutes for what one has. And you could claim that you could have maximum cheapness. In other words, the substitute can't get that far deviant before entry would occur, new things, new ways of supplying would come into the market if the prices get too far out of line. And the problem, however, is once you decide on what that level of substitution is or how far things can deviate, then it allows a speculator to add to their positions because something is becoming cheaper. They're buying, becoming cheaper, they buy, and continue to buy. But the problem is, as long as you have a fixed point, know what the maximum cheapness could be, then you could scale in. You know how to, you know the velocity. But once you get the flows start overwhelming you, okay, then you start having a trembling hand as whether this maximum cheapness or is there. As soon as you start moving the fixed point, then the velocity dies. So as Heisenberg said, either you can measure the location of a particle or its velocity or speed, but you can't measure both. So basically, the problem is if you're a speculator or entering into the process, that at times the speculator basically runs up against the maximum point, and then it becomes very, very hard to intermediate at that point, simply because the velocity becomes hard to measure or assume that there is a fixed point. And what we generally see is that the process tends to evolve as we look over time, and we have shocks occurring that occur either locally or globally. And as at the extremes, then we have capital market intermediaries when they become very uncertain about whether the flows are overwhelming substitution. This looks cheap, but it could get cheaper and cheaper and cheaper. Okay, then intermediaries rationally withdraw capital from the intermediation process just at the time why do they withdraw? They don't know whether their models are correct or the calibration of their models are correct. They need time to evaluate the information. So when we had the dot-com bust in 2001, then it was, or the telecom bust, there was the models that people had as to how to, maybe it was the network principle, and the model suggested build it and they shall come, okay, and that everyone was investing in dot-com companies with that in mind. And when the model was turned out to at least be deemed to be incorrect or not necessarily correct in both spheres, then what happened was that a lot of money was lost in the dot-com world and telecom world, something like $7 trillion, but time stopped. Okay, there was not that the venture capitalists and the private equity people were deer in the headlights. Time stopped because decision time stopped. In other words, one needed more time to make decisions of how to intermediate in that market, how to compress time. The model was now incomplete or wrong. The calibration of the models were not necessarily correct. That's when it's necessary to have the information set time to expand to regenerate our incomplete description of reality, because there's a meta model above the model we're using to make decisions. And as a result of that, time stopped, so prices became very volatile. There was firms, not money going into the business, and the speculator who's speculating needs time to assess or decide to go back into the market again to intermediate. Just the time in most markets when the demanders of liquidity or risk transfer are willing to pay much more for liquidity services. And then we see the indicia that David was talking about earlier today in markets generally, where interest rate curves steepen. People in liquidity crises, or when the speculators are withdrawing capital just at the same time as the demanders of liquidity want more liquidity, then it's the case that interest rate curves tend to steepen, credit spreads widen, okay, volatility increases, asset values fall, and time expands. You know, it means that it takes just longer for decisions to be made. The intermediation process becomes elongated, so therefore you have greater demand for intermediation. And the reason there's not immediate entry, because what are you entering? You know, you have to have time to be able to decide to go into a business if the model changes in what you're doing. So I think that that we have, it takes time to assess the dynamics of the model, and the natural providers are those who provide liquidity and risk transfer, Omega services, are those who have an understanding of markets and human capital, can actually have the contacts, such as financial service entities, hedge funds, private equity firms, real estate firms, because the information set is very large and takes time to really evaluate things. If everything was known to us, obviously everything I say would not be meaningful, but you do need human capital. I know that Professor Kaplan would say that we just need the business, but human capital is necessary to be able to assess, to be able to improve the information set of how to actually intermediate. You know, if someone says to me, well, there's been a shock in the marketplace and all of a sudden real estate's cheap. It went down. But I don't have any expertise. How am I going to know whether real estate's cheap or not? I don't know the markets. I don't know what the, et cetera. So if it does take human capital, and the interesting part about life is if you know something for certain, you build it in hardware, the hardware solution. But, you know, we're option people. So basically, if you're uncertain, you have uncertainty, then the lowest cost solution, just being able to target exactly the output you need, is the lowest cost, if you knew exactly what that output was. But if you don't have exactly that output, you need flexibility. So, that's the real option literature and et cetera. So the value of flexibility increases. So you move from a hardware solution to a software solution. That gives you flexibility. At the extreme, when you know nothing, you just need mushware. You just need thinking. That gives you the most flexibility. But it's most costly just to think. So that's why when you were students, you decided, you've got to get out of here and make money. This is very costly, just thinking here. But it's valuable because, it's at times a very valuable option. So that's the point, that mushware is important. I think that human capital is important. And then you also have to have the correct providers of these horizon investors to provide Omega services to the marketplace. And examples, if you're providing liquidity, if I say, I'm going to buy real estate today and I'm going to hold it for 2 weeks, basically you probably would not be a very profitable real estate person. You have to have a horizon, at least, which is greater than the horizon of the typical investor if one is going to be providing liquidity to the marketplace. So you have to be inframarginal or have a longer horizon to do it. One of the interesting reasons, I think, that the intermediation process is seeing disintermediation at this juncture from the broker-dealer banking world to the hedge fund world, which you now have a hedge fund, private equity, real estate funds, etc. Why that has intermediation process is left is because the horizon of the broker-dealer world, the banking world, has shortened. Okay, why? Because now with all the accounting changes, you have mark-to-market. They have to mark to market. They're public companies. They all use the same risk management systems. They bought into this crazy BIS world. They had to do it, a VAR, portfolio theory. And so they all use the same risk management system, so then they have to liquidate all at the same time. And as a result of having to do everything together, that it affects their earnings, and rightly or wrongly, they try to manage earnings. And if you, as a result, they provide liquidity to the market, and everything's honky-dory until, like you see this guy in UBS lost a few dollars in the prime market, bang, the whole group is dissolved. So liquidate everything into the market. So basically, their business is like the miller. Their business is actually servicing their clients. The banks servicing their clients, building idiosyncratic product to suit the needs of their clients, and then transferring the generalized risk to the market. They like to retain it because everyone who's in the oil business, thinks that their business is producing oil, selling gasoline or petrochemicals or heating oil, etc. But they love to speculate on the price of oil because they think they know what it's doing and where it's going to go. But that is not necessarily a positive present value business for them. So I think that the separation of human capital and is such now that it's leaving the broker-dealer world for a while. But I've been in finance for 42 years, I guess, according to Dick. And basically, the interesting part, everything in finance is deconstruction and reconstruction. So things come apart, okay, and break into pieces, but then we put them together in better ways in that sort of thing. So it's always the media center of finance. When I first started as a professor, as a professor, we had one box. That's how you got your stereo, your TV, woofers, everything in one box. Then all these components came out, just like we have millions of mutual funds and hedge funds and all private equity firms, all these components. Then you put them together the way you thought was best, and got the monster cable. You hired a guy to get that thing. I'm just interested in that. Last number of years, I'm sitting there. My person comes over, my stereo guy comes over, and TV guy, sit on the couch, Myron. What do you mean sit on the couch? I want to know about the Sony. No, how do you listen to your music, and that, or TV? So he says, all right, how much you want to spend? $2? No, I can't spend $40,000 or whatever it is. And lo and behold, he comes to my house, gives me a little clicker, and I go and click to see. I got my media center, so I got my box back, but it's my box, okay? not the standard one-shoe-fits-all box of 40 years ago. But then it starts deconstructing. I got this iPod thing. Doesn't fit into my media center. So all of a sudden I got my components coming in. But that's the same as finance. It's, just because we keep learning all the time. So it's form that counts, not how we do it, okay? And it's sort of the great things that we have. So I think that, I'm going to skip that. But I like to just sort of illustrate omega in the following way. This is a wonderful example of omega, at least I see in my area, okay? And it refers to pension fund investing in, and I'm going to talk about it in the UK, but it's starting in the UK, Europe, and to the United States, okay? And in the 1970s, Irwin Tepper and Fisher Black, who was wrote separate papers on defined benefit pension plans. Now, we know in the United States and Europe and the UK has large defined benefit plans. That we have 401ks now, which are defined contribution. The defined benefit plan, just to refresh ourselves, is the corporation pays the worker a certain fraction of their terminal salary through retirement years. So that's the defined benefit. And the pension plans generally in the UK are about 70% in stocks. The US is the 60-40 rule. Other parts of the world, probably the same thing. So stocks, invest in stocks. And Fisher Black and Irwin Tepper in the 70s said, that's stupid for the pension plan of a corporation, which is going to pay its workers anyway, regardless of what the pension plan assets are. It's going to pay. It's a corporate liability that basically it's better for them to invest in bonds, because if the pension plan invests in bonds, the corporation could borrow money, and since you borrow money as a corporation, the interest is tax deductible. Why in God's earth are you investing in equities in the pension plan? So you can re-lever yourself. But that died. I mean, Fisher Black is wonderful. He was one of those persons that Professor Kaplan referred to, and he was the aggressive guy, got out there, try to sell this thing, and he couldn't sell it. Pardon me? And you were the lamb. I was the lamb. I was sitting around just saying, ridiculous, Fisher, that you're not going to sell that. I just had a passive equity stake in that business, which made a lot of sense. But anyway, what has happened now is the regulators have become very aggressive, because in the UK, don't forget, in what happened in 2000 to 2003 was interest rates collapsed, okay, and interest rates collapsed, have been collapsing for a long time, but in 2000 they really collapsed, and at the same time we had that equity prices fell. So then all of a sudden regulators observed that on a mark-to-market basis, the liabilities of the pension plan went way up and the assets fell. And as a result of the idea that we tend to discount, at least the model is to discount the liabilities by the long bond rate, because their future promises 20, 30, 40 years from now gives you a present value, that investing in index funds and ETFs, which have zero beta, does not hedge the liabilities of the pension plan, because the correlation between bonds and equities is quite low. So you have a lot of basis risk. If you have a lot of basis risk in the pension plan, then you have to have a lot of stock on corporate account to be able to support the basis risk that you're taking between the assets of the pension plan and the liabilities, simply because if the equities fall and the liabilities go up, the corporation's underfunded. They have to put more money into the pension plan to be able to pay off on the liabilities to the workers. And conversely, if the assets go way up and the liabilities go down, then they don't have to fund as much, or they can promise their workers greater pension benefits to get rid of the excess in the pension plan. So the equity has to absorb these differentials. And obviously we know that investing in an ETF or an index fund in the pension plan is a zero present value project, because, if I invest in the stock market, I can't make money. I can make money in terms of return, but its present value is zero. I can take the money in and out tomorrow. It's not as though I put my money in the stock market today, and all of a sudden $100 in the stock market today, and someone says, okay, you just made $120, here's your $20. You know, that doesn't work. You get higher return, but that's the risk that you're being compensated for. So the actual problem is, why in God's earth would you invest in zero present value projects in a tax advantageous situation, okay, by putting the money into your pension plan in stocks? You know, that's the argument. Fisher, I'm still talking. Okay, so then the interesting part was that the mantra of the, whoops, what a sec here, this thing has attacked me. It remembers actually where I used this other system. Very fascinating. Okay, I have to do this by hand now. Okay, the idea is the mantra of the 70s through 2000, if you invest in common stocks, you earn a risk premium of 6%, say, over investing in bonds. And you've got a long horizon. Why in God's earth would you not want to invest in the long run in stocks over bonds? Okay, so that if you looked at what happened was, take General Motors. Okay, General Motors in 2003 issued $10 billion of bonds into the stock market and funded their pension plan. The actuaries said your liabilities just went down by $25 billion. So what do? Why? Because the actuaries project an 8% return on stocks. Okay, so they move money from their left pocket, the right pocket to their left pocket, and they just made $15 billion. So the basic problem is that if you project the expected return is going to be high, if you're going to make all this money out there, it makes a lot of sense to keep, to invest in stocks. So if you invest in stock, the actuaries will say you're overfunded. The state of Illinois did exactly the same thing. And we know that in the long run, you look at the Ibbotson-Ziegfeld data or any of these other people over long periods of time, and Jeremy Siegel, as you know, the Wharton professor, I don't know if you can mention that here in the West Coast, but there is a university in Pennsylvania, Philadelphia, which is the Wharton School. Jeremy Siegel's there, whose stocks in the long run, like Dow 30, 70,000 or whatever it is, and the idea that in the long run you invest in stocks, you're going to beat bonds, so it's virtually certain. So you're virtually certain, but then you say virtually certain. You look at them, long horizon. In fact, over the last 100 years, it's very hard to see a loser in that situation. Except if you do take a loss, do you have the staying power to have that great a loss? But anyway, so basically what happens, we say virtually certain. So maybe I should go to my broker, pension fund guy goes to the investment side of the bank, the options side of the bank, and say, my advisor, my actuary said it's virtually certain that stocks are going to outperform bonds. Said, how much is it going to cost me to get an option over the next 40 years? Since it's virtually certain, it must cost me virtually nothing to get an option to say I get the maximum, or a chooser option, to choose the maximum of the returns on stocks and bonds. Because obviously, I'd like to be in equities because they're going to perform more, but I want the assurance that I'm going to be able to pay off my liabilities. And lo and behold, it costs you 40%. You say, wow, a chooser option, 40% to get, and it's virtually certain. So you say, something's crazy here. But sure, the mean expectation is that you're going to outperform, stocks are going to outperform bonds. But the shortfall could be gigantic, because if you think about the projection over 40 years of where the stock market might be, and all the possible paths that you can have, the chooser option, to choose the maximum, is very valuable because the distribution becomes flatter and flatter. So if you have a shortfall, it could be gigantic. And so that means if you're an option theorist person, you say, I got to think about the whole distribution, not just the mean. But if you're a growth maximizer, which is the old story, you choose the mean if that's the way you want to do it. But the pension fallacy is that you have this long horizon, invest in stocks, but it's not a sure thing. On the other hand, when the correlation of returns, the optimal policy has become is so when the correlation of the returns of the pension assets and the pension liabilities increase, then the risk of the corporate equity falls, so it has less basis risk associated with that. It sells its cross holdings of equity and replaces equity with long-term bonds to reduce its risk, okay? And the corporation could issue debt and buy back the stock to restore its equity to its previous point. So in other words, initially you start off, in the pension plan you have equities and debt to your employees, and you have assets, and you have equity at the corporate level. So now you change the upper level and immunize that. So you now buy bonds and issue debt to your pension liability persons. That gets rid of that risk. But that means your beta, or the risk of your corporation, falls dramatically because you got rid of all these index funds that you're holding. And you wouldn't pay a corporation a dime to go issue equity and buy an index fund, right, on its balance sheet. I mean, that's a closed-end fund. It tends to sell at a discount. So basically, because of the management fees, et cetera. So basically, once you immunize, then it's the case. Once you immunize, then the risk of the corporation falls. To get back exactly the same risk level, you issue debt and buy back all those cross holdings that you sold. So the equilibrium is no effect whatsoever. Okay, but the question is that if you look at the, I don't want to do that. Should come up. Guess not. Huh. It's a little tricky today. Never fails me. Okay, if you look at what's happening in the UK, that's very fascinating. Never did that before. If you look in the UK, the regulators in the UK have told their pension plans, just quickly, okay, have told their pension plans that you're going to have to mark to market the basis risk, the change in the assets and liabilities on your balance sheets, and the corporations in the the risk police in the UK, the equivalent of the PPGC, have told them that they have to, additionally, they have to pay extra premiums if you have this basis risk. So they're starting to measure. People are trying to put the pension benefits on the balance sheet, which is great. I think we should have pension on our balance sheet. But anyway, not to explain, this is sort of, if you look at the long end of the curve, how expensive the long end of the UK curve has become relative to the 10-year and the 2-year. But let me explain it a different way. If you look at the potential of the UK economy from now for 15 years as measured by the real rate, it's a 3.5% potential of the economy. 15 years, 20 years forward is 70 basis points. So you can say, yeah, the market's forecasting that the UK economy will have this wonderful potential for 15 years and then fall off the cliff 15 years forward. It could be 70 basis points, but that's one explanation, okay, the general model of equilibrium. On the other hand, you could have the situation where, as I said, the pension funds are acquiring very long-dated bonds in the marketplace as the regulators have acquired them to do it. So that either they're closing because of these risks, they're closing their pension plans, which create this large demand for the long end of the UK market to hedge their liabilities, which is creating a supply-demand imbalance as they're trying to transfer the risk to the marketplace. They're transferring the basis risk to the marketplace. And as a result of this, you see after this demand, so at the long end of the curve, becomes more and more expensive relative to the other parts of the curve as the flows continue to increase as pension funds keep needing long and dated assets. Then we see substitution occurring, or supplies start to come into the market. How do supplies come into the market? Supplies come in through actually utilities issuing long-dated instruments, or governments skewing their issuance to the very long end, or corporations starting to realize that they can do what I said. You know, if they balance the risk of their assets and liabilities, the next step as a management decision is to actually go into the market, issue their own long-dated bonds, and buy back their common stock. And that's what we're seeing now out at the long end of the curve. Tesco, for example, issued a 500 million pound bonds on the real estate holdings, which are their very long-dated assets. They have, and Marks and Spencer's doing the same thing. HSBC's doing the same thing, and starting to issue at the long end to buy back their equity with the excess of the debt, bringing the market, starting to bring the market back into line. Now, basically, the idea is that if you have a demand, if you have the pension plans and the corporations could do both pieces simultaneously, okay? But if they don't do both pieces simultaneously, then you create a demand-supply imbalance in the market where you need intermediaries to come in. It's the same thing as the pension plans selling the wheat crop to the millers, okay, and the millers having to use the speculators to transfer the risks until the supply re-equilibrates in the market where you have equilibrium. So you have a compression of time, and that's where you can have mega providers actually providing intermediation services to the market. Now, the pension plans of the corporations know they're paying. No one who's crazy could look at the long end of the UK curve and say, what is it? Who's going to think the economy is going to be 70 basis points? That's why it's so extreme, you know, and 70 basis point real rate. You have to finish up in 1 minute. Okay. And then, but let me I want to quit here for a second. Get out of here. Quickly, because I want to just have one last point, which will tie everything together with this conference. And, oops, I don't want to go that way. Let me go back to here. Okay. Just 1 second here, if I can figure out how to do all this in my old age. Okay. I'm going to go this way. But I think, you see, the interesting thing in economics and finance, just the last minute I have here, is that the equilibrium, there's a trade-off theory. This liability asset management is not the optimal. That's what the latest is. But you think about finance, okay? What is the pension plan of a corporation that has a defined benefit plan? It's a wonderful thing because it's a tax advantageous asset. So you want to hold positive present value projects there, not zero present value projects. So you say, well, if I completely balance my asset and liabilities, well, it's gone. But what if I take basis risk by holding private equity or real estate or venture capital in my pension plan that have positive present value, either through alpha or beta or omega? Then if I'm allowed to invest in those things. You know, I can invest in I can invest in operating businesses. I can do that in my own corporation. But in the alpha generators or omega generators, I can take basis risk. So I don't match the assets and liabilities, but I have bonds in my pension plan, so I immunize, and then I deviate from that, so I have basis risk. If I have basis risk, I have positive present value, which means I'm adding value for the corporate shareholders or the pension beneficiaries. And on the other hand, the trade-off is that now I need more equity to support the fact that I'm on the corporate side. I need more equity on the corporation side to support the fact that I'm not immunized. Okay? And so the trade-off is I have less debt capacity, which has the tax disadvantageous part. So you have to optimize. Don't immunize, but think of the pension plan, which is tax advantageous, should be holding the high turnover inventory businesses, the omega businesses, the ones that are generating high turnover, because on personal account, if the corporation held them on personal account, it would be fully taxable, or I as a high net worth person. So there's a trade-off. You have a trade-off between what assets should be held in the pension plan or not. So I'm sorry I went over it, but I'll stop there and